What is up? Happy June. It's the first of the month.
First of
Happy
the month,
Friday.
rinse due, baby.
The rinse. Got to pack your bags and get up.
Do.
We got some. This is going to be a great month because June is our deal analysis intensive, and we've talked about this before, but we're going to hit it hard in June. We're just going to look at every aspect of the deal. Albert, how are you doing?
Man, I'm doing well. I'm nice and tanned. Back from our week-long vacation in Puerto Rico. Everything was amazing. And yeah, now back at it, my man. Ready to get this new month started. I mean, I don't know how many times I've told you, Austin, I love Mondays. I love first of the month.
Mm-hmm.
And it's just a fresh week, fresh month, you know. I'm ready to go.
I'm the same way. I love New Year's Day. I love the first of the month. I love the first of the week. And also love the first of the quarter too. So
Yeah.
we're coming up. We're ending the quarter strong. So right now, June is your setup month. June is a setup month because every third month of each quarter kind of sets you up for that next quarter. So I read this book called The 12-Week Year. Have you read that book?
No, I haven't heard. I've heard of it, but I haven't read it.
It gets us really thinking about breaking down our goals into quarterly goals. Have a mindset of quarter to quarter, which I think is very interesting, and it's a very interesting perspective to have. If you haven't read that, the 12-Week Year, I do recommend that. So yeah, Albert, why don't you tell everyone, first of all, welcome to REI 101. We are streaming live. We are on YouTube today, streaming live on YouTube. We'll have the recording on Spotify and iTunes and all that. But welcome to REI 101. This is our 57th episode today, and we're going to be talking about cash flow versus appreciation today. But Albert, you got to tell us, why do you look so different? You look especially crispy today.
Especially crispy.
Yeah, man. You
Nothing's burned, just a week-long vacation in Puerto Rico, and it's been a long time coming. We haven't had a real vacation for a couple years, so since 2024. But it was really great, man. Had a good time, but we're back, and I had some realizations while I was traveling, and
oh,
that
do tell.
was man, I can really run this business from anywhere. And that's a lot of freedom that we have being in real estate, or at least what we do in real estate, which is working with good builders and contractors.
Yeah,
All right, that you can trust, that can send you project updates, things like that.
yeah,
You got access to, as long as you have an internet connection, you can run your business. So that was really cool. I did get a chance to really unplug for, I would say, at least 95% of the time that I was there, maybe even more. So it was a
yeah.
real vacation. Of course, I take my laptop and everything with me just in case, but nothing blew up. Nothing required any type of critical. There were no critical emergencies and things like that. So that was cool. But that was a really neat realization, Austin, was I can run our business really from anywhere. So that
Yeah.
just kind of affirmed what we were trying to do over the next 3 to 5 years, which is just kind of be able to travel and work and run our businesses. And so that was some confirmation that we got over the week.
That's a huge thing. And if you go back to like our vendor series, and last year we had a series about scaling and systems, and we're going to be revisiting that in October. We have a whole month plan for scaling and systems. But the fact that you've been systematic, you know your processes, you have it laid out, you have the right people in place, that gives you a lot of freedom, doesn't it? To
Oh
go out
yeah.
it and still know, you don't ignore your business. I'm sure you didn't completely just
No.
ignore your business where you were gone, but you don't look very stressed. You're not a very stressed person, and I can tell
Mm-mm.
you, Albert, that you got a lot more going on than most people I know, and it's just a matter of it's just having those systems, right? I mean,
Yeah.
what's your key to success? What's your key to kind of being able to take a time out with, because you got a lot going on. Portfolio, you have a pretty wide portfolio, property
Right.
management, and you're actively buying. You probably have something under contract right now, don't you?
I mean, no, we don't have anything under contract, but from our properties and the properties we manage as over 25 units, we have a coaching program. So we're mentors. So we're connected with multiple investors that are getting their first. We have some of our investors close on their first deal on Friday,
Hmm.
a triplex in Houston, and we're in the process of building 7 units. So two duplexes and three single family homes. The secret to all that success and being able to do that is people and processes. Like you said before,
Yeah.
is trusted vendors, trusted contractors, builders, handymen, you know, but also like I'm still part of the business, I'm not completely removed from it.
Right.
I still pay attention to it. And because that just fills my cup, Austin. I like doing that. And so, but that's really the secret, is having the right people around you, the right teams, and working to build that and put that in place
Hmm.
that gives you that flexibility, yeah, and that's just an evolution over the last 5 years, 5, 6 years since we've been investing. It's just evolved, right? Where instead of me wearing all the hats or having to go out and fix things at houses and having to go out and check all of these job sites, is now we have solid team and solid people around us where I don't need to do that.
Yeah.
So
Yeah.
that's really the success part of it.
That's important, and it has a lot to do with your mindset as well, right? I think that I think that there are some misconceptions when it comes to what the life of a real estate investor looks like. And the
Mm-hmm.
first thing I always hear is, I don't want to be a real estate investor because I don't want to unclog toilets in the middle of the night.
Right.
And we all know that that's just hogwash. That's just not how things are if you know what you're doing.
Right.
Now, if you are a real estate investor and you find yourself constantly putting out fires or running in the middle of the night to address little things that probably should not require your time, then you're in the right place because that's what we're here. We're here to teach you how to be a good real estate investor. We're here to cover the basics, and there's a lot we can learn from each other and from the guests that we have on this show. So it starts off by managing a property at a high level is extremely good. Not only is it going to make your property more valuable, it's going to make your life a little nicer just to have
Mm-hmm.
kind of your ducks in a row. And so we do talk about that, but also we gotta talk about buying right. And
Right.
so you can't buy a great deal unless you know how to evaluate that. And that's what we're going to talk about. We're going to look at things today through two different lenses, right?
Mm-hmm.
The first lens is we're looking at basically two models. So the first one is cash flow. It asks the question, if I buy this property, I'm going to have a mortgage, likely have some debt on it. How much income is this going to produce on a monthly basis? That's number one. But there's another lens that we want to look at properties, and it's not the cash flow, but it's the appreciation. If I buy this property and then sell it in 5 years or 10 years or whenever, what can I expect the value of that property to be over time? Now, good investors look at it one way or the other.
Mm-hmm.
I think a great investor is going to look at it through both lenses, right? Do you agree?
Yes, no, I definitely agree. You're going to look at both. One just may matter more to you depending on like the phase that you're in
Hmm.
investing, where you don't necessarily need a ton of cash flow,
Yeah.
and you're in an appreciating market. Not all markets appreciate at the same rate. Depending on what you're kind of, whether it's financial independence or if it's early retirement or something like that. What does that timeline look like? Do you have 20 years, 30 years where you really want to work on building this portfolio? Or are you kind of a little bit older? Maybe you only have a 10 or 15-year time horizon where it's like, man, I need to get some cash flow quicker than waiting for this appreciation to
Yeah.
play. So, but yes, it's definitely important to look at both.
Yeah.
100%. I think there's one might matter more than the other.
Yeah, and it is depending on where you are in the journey.
Hmm.
So here's a question to ask yourself: would you rather make $300 a month today, or would you rather make $300,000 in equity over the next 10 years? Is that equity worth maybe not cash flowing, or is that cash flow worth maybe not seeing appreciation and building equity? So why would this be a debate between investors? Like you said, I don't think it really is a debate. I think it's more of a perspective in where you are in the journey.
Hmm.
Like you said, both strategies they can both work. They're both important, but you need to know what game you're playing.
Yep.
And the equity guys, they know. I think more the equity guys are going to be more experienced. They're going to be more comfortable with a little bit more risk, right? So here's the two models, and if you're in a place you can write this down, you're gonna want to really be able to distinguish between these two models. The first one's the cash flow model, and the second one is the appreciation model. So,
Right.
Albert, talk to us a little bit about cash flow, and we do have some. I do have a an example that
Yeah.
I can share, but let's talk
Yeah. I
about the
think
cash flow model first.
Yeah, I think like with new investors, it's kind of easy to get lost in that term cash flow, because they may get have a property and they're renting it out for $1,700. A new investor say, "Great, I'm gonna make $1,700 a month on that property,"
Hmm.
but they don't understand, or they'll learn as they go, as they learn. Okay, I have a mortgage, right? Like you mentioned before,
Yeah.
they'll have debt on the property, right? So they'll have that rental income, and then from that rental income, they need to subtract all the debt. So that's their mortgage payment, which sometimes will be escrowed, right? Taxes and insurance will be plugged in there. They need to set aside a little bit for future repairs and maintenance. Hopefully they took care of a lot of that stuff up front before they put it into service, but things
Yeah.
break over time, right? They need to account for vacancy, property management if they're going to have a property manager managing it for them. I like to count property management even if I'm self-managing, because in that way, if it's still cash flowing when I'm managing it, but I've already accounted for property management, when I step away, that number doesn't really change,
Right.
right? So I just kind of pay myself that property management fee. And then that's what you get, that true cash flow
Hmm.
number when you subtract all those expenses, you know? So as I mentioned before, Austin, the cash flow may be more important to some investors who kind of need that stability, right? They're trying to replace their income, and they're not too worried about appreciation, or maybe it's on their radar, but they just like cash flow, because they have just lower risk,
Right.
right? And they want to just replace their income. And those are people that I see, right? They're accumulating properties with high cash flow, so then they can just replace their income and then walk away from their jobs
Yeah.
eventually.
Yeah.
That's how I look at it.
Absolutely. Absolutely. So let me pull up. Uh, we're going to look at a real life example
Let's do
of
that.
of how that plays out. So this is 3040. This is an active listing. Is it a great deal? Probably not yet. This is something
Not
that
yet.
we would probably want to get some negotiating on. First thing that we notice is that it's a 6.91% cap rate. And what that essentially means, cap rate has nothing to do with the financing. That's the return. That's a hypothetical return on investment. If you were to purchase this property cash, that's your
Okay.
return on your
Mm-hmm.
investment is the cap
Mm-hmm.
rate. So basically, your NOI, this 47,998, that's the net profit. That's like you said,
Gotcha.
it's your income minus your expenses equals profit. Now, that does not take into account a couple of things. Number one, it does not take into account debt service. That's another layer of the equation is debt service. The other thing
Mm-hmm.
that this should not take into account are any capital expenditures. So while your utilities and your lawn maintenance, those are normal month to month costs, replacing the roof doesn't happen every month. It happens once every 20 years. or so often. So
Mhm.
any major improvements like that's going to be below, we call that below the line. Debt service is below the line. So what we're looking at when we're evaluating a property, we need to know, start off with an ask price, but we need to know what that current NOI is. And that NOI, that's the profit based on a 12-month period.
Mhm.
Okay, so now I'm going to show you this tool right here. So
Oh,
if I go ahead.
no, go ahead.
So if
I'm
I were to
interested.
purchase this property at $695,000 and the net operating income is 47,998, and let's say I can get like a 20% down loan. And typically in commercial, with anything more than 4 units, your term's going to be like 25 years. And now in the commercial space, your interest rate's typically going to be a little higher than if you were to buy a single family home for your family. Right now, if you were to buy a house for your family, the average interest rate for conventional financing on a single family home is about 6.53, 6.54%.
Mm-hmm.
Your interest rate on these commercial deals, if you borrow from the bank, will be significantly higher.
Mm-hmm.
So with this number right here, I've got my NOI at 47,998. Purchase price is 695. I'm going to put down, I'm going to invest 139. That's my investment. That's my down payment.
Mm-hmm.
So at 20%, at 7.25 at 2 and 25 years, I'm actually losing money there. And the reason I'm losing money is because my debt service is higher than my net.
And that's typically when like on this calculator, is that mainly your principal and interest? Does
Yeah.
this even account for taxes and insurance? Oh, because taxes and insurance were taken out on the
Yeah.
expenses for the
So
NOI. Gotcha,
yeah,
gotcha,
taxes
gotcha,
and insurance come out before
gotcha.
the NOI
So
right
what
there.
number makes sense? Like, what if your purchase price was 500,000?
So there's two ways you can approach this, and
Okay.
you want to look at it. So if I'm going to give this seller the benefit of the doubt, I'm going to ask this seller. This is the question that everybody in the space is asking: is this seller willing to finance it? If they're willing to finance it, we may be able to get that 725. And look, if I change that 725 to a 6.25, now I'm cash flowing $4,000 a year.
Mm-hmm.
Now there's another number here. I mean, that's a pretty big difference. There's another
Mm-hmm.
number that we have to look at is DSCR. DSCR. This is a debt service coverage ratio. Very simple number, and it's a very powerful number if you understand this. This just means that for every dollar that I'm paying toward my mortgage, I have 9 cents left over. So I'm basically it's 109 my it's 109% of my debt service. Like my profit is higher than my debt service.
Mm-hmm.
So the cost of the money is cheaper than the income. This just means that you have money left over after you pay your mortgage. But if I'm at 7.25, then I'm breaking even. I'm actually losing a couple
Oh yeah.
hundred dollars. So first thing you can play with these financing numbers, but what we really want to strive for is to get that DSR closer to like 1.3 to 1.5. So we may, and you'll see that like going a point down on the interest might actually make more of a difference than coming down like 50 grand. And you can
No,
see
yeah.
like
Yeah. 50
it
grand is
was
nice.
like
Yeah.
50, a point on the interest is worth
Oh,
more than 50 grand on the purchase price. So it'd have to be a combination. If we're going to stay at 7.25 and we want to get this DSCR to 1.3, like we're going low. We're going real low.
yeah.
Like it's it's like $175,000 off the top just to get that DSCR up.
Yeah.
And so it's good to be able to play with those numbers. And right now with banks lending at such a high level, it's it's important to ask that question if the seller can finance it. Some of these notes may or may not be assumable. That's always something to look at.
Mhm.
That's just cash flow right
Right.
there. That's not to say that the value of this property is not going to double in 7 years. If you pay 700,000, you may be able to sell it in 7 years for 1.4 million. I mean, that's a quite a bit of money, right?
Hmm. So how do you determine that appreciation like rate? Is this just, just for this particular area? You just have to look at data.
You have to look, yeah, it's kind of a tricky thing to do. Uh, it's easier to do this with single family homes because I can show you. Um, I'll talk about single family houses first, and then we'll look at the multifamily stays.
Right. So that kind of takes us to the next model though, right? The appreciation model.
Yeah, and that goes back to appreciation. So what I got right here, and I'll just kind of show you. Um, this right here, every month, this shows that the average sales price of a single family house. And in May, believe it or not, an average single price, the average price of a single family house in the month of May was $454,000.
Hmm.
So May was a strong month compared to like the last year. You go back to May, it's actually up. April was down, May is up. You go to May 2023, where we at? May 429. So what you're looking at here is you're looking at appreciation. And your question was, do you look at the big market or do you go macro or do you go
Right.
micro?
Micro.
Yeah, you want to do both. You want to look at it both ways because um, you want to see if there's a trend
Mm.
in that community in that area and maybe in that zip code or maybe that school zone, you know. There's other factors that can affect it too. You know, there's homes in League City that got rezoned to like a different, I forgot what school zone, but um,
Oh yeah.
there were houses that got rezoned to other school zones.
I heard
There's,
about it.
there are other factors that can affect that, but you do want to look. They say 7 years is kind of that rule of property should double in value. I don't know how consistently true that is, but it sounds
Mm.
really good. Uh, in commercial, it's probably truer to an extent. Um,
Yeah, I don't know. I don't know market. I haven't seen a market, or I don't have any properties in a market that where I feel like the property values double every 7 years. I mean, we've been in for like we closed on our first refinance in 2021. So we're 5 years into like holding long-term debt,
mhm,
right? And we got properties. I say that just because that's when the properties were last appraised,
right.
and I will say every property that we have, the one that's really close to doubling, but we've owned the property for almost 10 years is our League City property. We've owned that property for 9 years. And when we bought it, we was maybe 275, and it's
Hmm.
probably maybe 420,
Yeah.
right? So kind of close, but again, we've had it for more than 7 years. I just don't know the market that doubles every 7 years.
Well, this is Houston. These are multifamilies in
Mm.
Houston. So May, the average
Multi. Okay.
multifamily was 445. And this is on HAR, so this is like really like 2 units to 12 units. But you can see 220, that was in 2018. So that's 8 years.
It's
It
really
doubled.
inexpensive for multifamilies.
Yeah. So if you buy something for $250,000 and it doubles in value, what's important here is the power of leverage. Because if you buy something for $250,000, you're only putting $50,000 down.
Hmm.
And this is the part that I think a lot this is the math I think a lot of people skip is you're not investing $250,000. You're investing
Right.
$50,000. And if
Right.
it doubles in 8 years, you're actually seeing a $250,000 return on your $50,000 investment. So
Hmm.
you haven't doubled your money. You've 6x'd your money by putting 20% down.
Hmm.
So by the time the value of the asset doubles, it's actually it's actually six what is that? Sextupled. Sextupled.
Yeah, I
So
got you. I got you. Okay. Cool.
all right, so moving on. So let's move on and talk some more about the appreciation model because I mean that's probably like everything just just in just in a nutshell right
Yeah,
there.
I think like with how I look at the appreciation model, at least from my perspective, is if you're focusing on that particular model over the cash flow model, like you just pointed out, you have to look at more data. I mean, you can look at rent trends and things like that because your rent typically will appreciate as well over time. But when you're looking at the appreciation of the asset, of the value of the asset, you're looking at a lot more data, which is kind of what we just looked at. You have to be a little more tedious and methodical, looking at data from multiple sources as well, right? Just kind of comparing those things.
Hmm.
Um, we obviously look at all of our properties over time, right? We have some that we owe less than $100,000 on some of these rental properties. I think we owe like $90,000 on one of our rental properties. And our goal is really to kind of pay some of these down like very quickly, if not pay them off over the next maybe
Hmm.
5 to 8 years. And so then our cash flow goes up, right?
Yeah.
Because we no longer have this debt service on here
Yeah.
anymore. So our cash flow goes up. So that's great. And the appreciation continues to go up because we're going to hold on to these properties for another 10 or 15 years.
Yeah.
So like both of those things. So then someone like me who's 50, when I'm ready to start traveling more and kind of hit that golden years era, from like 55, 60 on, right? Well, we just sell one or two of these
Yeah.
properties. How much of that you'll retire? So that's the retirement that a lot
Yeah.
of real estate investors are building like this portfolio, right?
Yeah.
You have the cash flow, but you have this appreciation as well. And that appreciation really is kind of that can be part of your portfolio, your retirement nest egg.
And go back to our February series because you can do that tax deferred. You can put all that in a tax deferred retirement account and uh, just start selling it out. Like once you get to that retirement age, you can
Right.
just
And
enjoy
that's
this.
and that's what we talked about too, was that's how you build wealth, right? Right.
That's right.
Is holding on to these properties for a long period of time. You let the renters, the tenants, the guests pay down those mortgages, right? Your interest rate is typically going to be fixed, at least on single families, right? Your interest rate is going to be fixed. So your minus the changes in taxes and insurance, your mortgage relatively stays the same
Yep.
over that amount of time,
Yeah.
right? But your rents tend to go up, so you kind of can pay that down a little bit faster, depending on how much money you want to pay or how much you want to just shovel into that. So that's what I love about the appreciation model. I love them both. You
Hmm.
said good investors look at both. I love them both. But that appreciation model for somebody like me, 10 or 15 years down the road, I want those properties to be appreciating.
Yeah. That's good. So you want to look at that future resale value. And just as you were asking, how do you know what the future resale? Well, the truth is we don't know the future. We can speculate. And in fact, there are some people, not me, I don't play that game, but there are some people that are really good at it. They know based on what's developing in the community, what businesses are coming in, what roads are being, they can tell you like this is going to double in 4 years or in 3 years as opposed to 8 years or 12 years. Same thing, you know, if it's an area that, you know, has it's going to get worse or it's just not there's no sign of it growing, there's some people that can speculate. Um, the best way to determine the future conservatively is to look at past trends. And I think the further back in time you're able to go, the more accurate your future trends will be. And what you're looking for is you're just looking for sales uh, average sales per unit. So if it's a single
Mhm.
family house, what's the average sales price of a house? There's a lot more variables to that. And if we had time, we could go in, because you'll see when we've done this before on shows where you know, 3 bedrooms versus 4 bedrooms, and you look at the trend lines going back 20 years, and you may see that I think we did this about 3 or 6 months ago, where we realized that the trend for 3 bedroom houses was actually appreciating quicker.
Mhm.
Remember that?
Yeah.
In some communities, 3 bedroom homes appreciated faster than 4 bedroom homes.
Hmm.
Now, the average sales price, the average values of a 3 bedroom homes were a little bit less, but the appreciation rate was greater. And that's a very powerful thing. Um, Homes with a pool. Do they appreciate? Do they not? Do homes over 2,500 square feet, do those appreciate faster than homes under 1,500 square feet? I think one thing I was listening to over the weekend is that did you know the average size of new construction is getting smaller every year?
Yeah, that sounds about
New
right to
new
me.
new construction is getting smaller. So other factors to look at is job growth, population growth. You may be looking at an investment in a quiet area, but in Grimes County, for instance, Conroe and north of Houston, they're building data centers up there. I mean, do you think that's going to have an impact on the value of a single family house?
Yeah,
I
I think
would,
it'll
t-
happen.
I would totally think so. Yeah,
Yeah.
that's going to, not only is that going to uh, produce a tremendous amount of job growth for that area. Those guys make more money than average people, you know, right
Hmm.
now with the AI boom. So other things like development trends, that we talked about the 96 corridor, the any roads being new highways, new roads.
Hmm.
Is there an HEB being built nearby? Like all those things do make a difference.
Or you look for, I mean, you look for Starbucks that's popping up, or you look for
Yeah.
Chick-fil-A that's popping up.
Yeah.
I don't see too many Walmarts popping up anywhere, but definitely grocery stores are still popping up here and there. You can do research into schools, because you've got migration patterns, you've got things that have happened in certain areas where the population has actually shrunk a little bit because we talked about population growth and that can impact the schools. It can impact the number of schools that you have to choose from,
Yep.
which it's kind of a snowball effect. If you got population that's leaving and you've got schools that are closing, and it just kind of gets
It all
more
affects each
critical.
other. It's all
Mm-hmm.
connected.
Yeah.
But yeah, if you don't know how to look at those things, ask your real estate agent. Ask somebody, good questions to ask are what are the growth trends? What are the trends in income? What are the population trends? Is it more densely? Is population density changing? You know, all that, professionals will have access to that data. But all this information is going to be good for you to be able to make great decisions when it comes to to purchasing, um, because appreciation is a very, very powerful thing. And if you're buying in an area where it's like totally going to grow,
Mm-hmm.
then
Yeah.
you'll want to know that.
Yeah. Cool. All right. So now we can kind of put these things side by side, right?
You're right.
Since we've touched on both of them, right? Is cash flow deals and appreciation deals. What are some of the pros and cons of cash flow deals?
So obviously, with cash flow, it's easier to hold during market turndowns. Right now is a perfect example of that
Mm-hmm.
because we haven't seen a lot of appreciation in the last 3 to 3.5 years. The 3 years before that, it was insane.
Right.
It was just ridiculous, right? So it's kind of easier to hold on to, um, but you got to want to hold. You got to be ready for the ride.
Mm-hmm.
The other great thing is it gets income. It produces income sooner. So if you're, just trying to get into the game, I think we both agree that for new investors, especially, you've
Yeah,
got to get a cash flowing property when you're started.
definitely.
Your
Definitely.
portfolio always needs to cash flow. Does that mean that you can't have a couple of wild cards? in there. I mean, that's good. That's going to be really good once you get kind of further into the game. But for newer investors, you got to get that that income.
You don't want to do something that's going to take you out the game. You
Yeah.
know, don't want to
Yeah.
get stuck with a property that's you've got no appreciation, you've got negative cash flow on that thing, and it's just eating away at your reserves. You know, it's keeping you from making the next move, right? So getting cash flow, a cash flowing property on your first deal that you hold, I think, is definitely key
Yeah.
for sure.
That's right. That's right. So
Yeah.
here are the cons of the cash flow. Um, it may appreciate slower. You may find that negative cash flow deals appreciate faster in some situations. So you do want to keep an eye. You do want to know, like, and this goes for anybody looking to buying a house, because we've seen already, we have clients in the situation where they bought less than 3 years ago, and now life has changed and they have to sell,
Mm-hmm.
and now they don't have equity in their house. So you never know how long. We don't know how long this economy is going to maintain this trajectory. You know, it could be a while. Um, the cons, cash flowing properties, usually your higher cap rate cash flowing properties will tend to be smaller, less expensive, more of a C class, more of a D class. Those type of properties tend to need more repairs. Those are the scary properties for a lot. Sometimes the scariest looking properties are have the most uh, cash flow at the end of the
Mm-hmm.
day, you know.
Yeah.
So
A couple
they're going to
less.
need more repairs, right?
Yeah, yeah. And then you mentioned that they might be in like D class areas, right? So your tenant pool might be a little more difficult to screen, right?
Hmm.
Maybe not necessarily difficult to screen. It's just after you're screening, what's left, right? Who makes it through that screening
Right.
process? So
Yeah.
you kind of have to take that in account, right? And that just kind of goes with what you said with the location and things like that. Um, so for like appreciation deals, right? Like the pros are kind of the opposite of the cash flow,
Yeah.
right? So the pros is you got that, that long-term wealth potential because you've
Hmm.
got that property is appreciating over time. You
Right.
know, you may not, you're not going to have that immediate cash flow like we mentioned before, but if you've got that long-term wealth potential, that appreciation, then your rents are probably going to appreciate as well,
Yeah.
you know. Um, Resale, right? And we touched on that a minute ago, right? 10 or 15 years from now, how much has that property appreciated? And now you're ready to kind of just ride off into the sunset a little bit, so to
Yeah.
speak. And now you can go resell this property for a lot more than what you purchased it
Yeah.
for, you know?
That we see that a lot in land, the term land baking, if you've never heard of that. Somebody may just
Mm-hmm.
find a piece of dirt. You can't really rent out. I mean, you can. We do have a ground lease on the market. It's challenging. There's a very low demand for that product.
Mm-hmm.
However, um, we see this a lot with land because land does tend to appreciate, even though land sales at the moment are very low. But we do see a lot of investors, they'll buy acreage and just hold on to it and just bank on the appreciation, maybe get an exemption on it, but just let that land appreciate. Um, so yeah, there's a better resale demand there. Um,
Yeah. And
Especially if
then,
they think that something big is going to happen in that area, and having that piece of dirt when they start developing all around it, you know. If you bought a
yeah,
lot in downtown Houston 25 years ago, you're you got a big return on your investment coming.
yeah. Or if you held on to that property that you had in Edo, right,
Yeah.
10 or 15 years ago, when
Yeah.
it was the very start of the gentrification and things down there
Yeah.
that just went really slow, but look at it now.
Yeah. While
Yeah.
everybody else was saying the sky was falling out in Edo, you know, and
Yeah.
now it's blowing up, right? So,
Yeah. Yeah. And then, these properties that appreciate faster over time, right? They tend to be located in better areas,
mhm.
right? Because you've got that path of progress, you've got those HEBs going up, right? So they're in stronger economic areas. right?
Yeah.
And so then the cons, right? Very little cash flow, if any, right? At least early on,
Yeah.
you know. So maybe the first 1 to 3 years, you're not really cash flowing, but you're taking a look at the trends. Okay,
Yep.
cool. I'm gonna hold on to this for long term. It definitely does require like stronger reserves, right? To have your reserves shored up because again, these things may not be cash flowing and your expenses might go up a little bit with insurance and taxes and things like that.
Yeah.
So you want to be able to make those cover those if you do have a cash flow loss, you need to be able to cover that, right?
100%. 100%.
Um,
Yeah.
so sensitivity to market cycles, like what does that mean to you? Like for
Um,
like appreciation deals.
yeah. So for instance, if you buy like a $500,000 home, and the market takes a downturn, those
Mm,
middle to upper class products are going to
mhm.
tend to kind of go the way of the market.
Yeah.
Especially if you're holding on to that for rental income, because you may have heard of the 1% rule, which really only applies to a certain price range of properties. But if you
Correct.
buy, $1 million house, you can't expect to rent it out for $10,000 a month. That's just
Right.
not going to
Right.
happen.
Yeah.
But if you buy $100,000 house, getting 1,000 a month is very
Very
reasonable,
doable.
you know? So sometimes those mid to higher priced uh, pieces of real estate are going to be affected more to market cycles. Um, right now, we're seeing this like opposite, this like counter trend in high end luxury, where luxury is thriving right now, and not just in residential single family homes, but like across the market, like beyond real estate, we're seeing
Hmm.
like luxury is still going strong, which is interesting. Um, And then, yeah, the same thing. It's going to be harder to hold if your income changes. So having a uh, a 300, 400, $500,000 house with a vacancy hurts a lot more,
Yeah.
um, because they
100%.
can stay. You have a smaller tenant pool with
Hmm.
those higher valued properties. You have a smaller tenant pool. So because you have a smaller tenant pool, you're going to have a higher vacancy rate.
That's
And
right.
so your vacancy rates are gonna, I mean, you're bleeding money until you get a
Yeah.
tenant in there.
Yeah.
So,
All right.
all right, so we can wrap it up. Couple of questions to think about as we go into this analysis month and now analyzing these deals. How should you be thinking about the properties that you're evaluating or looking at? Number one, am I investing for income or net worth? I
Hmm.
want to
Or both.
encourage everybody, yeah, look at both. Always look at both. Even if you're an income guy, look at both. Anybody doing this real estate investing, the keyword there being investing, track your net worth. We've talked about that before. And if
Mhm.
you need a net worth tracker, shoot me a text or shoot Albert a text and we'll get you a net worth tracker. Be
Gotcha.
tracking your net worth because at the end of the day, that's kind of like the best gauge of how well you're playing the game right now is if your net worth is improving or not.
Definitely.
What's the second question, Albert?
Right. So, what if, because we kind of talked about this, is what if this property breaks even, right? Or you're a little bit cash flow negative on the property? Can I afford to hold on to it? You know, and you kind of start to figure that out right away
Yeah,
as you get through the project, whether you're trying to flip it or you need to hold on to it. You're going to go DSCR it, and you're looking at all the numbers, and you're just taking a look at your reserves. You think about what your next steps are, what your next investment is going to be. You know, when we look at our portfolio in general, yes, our entire portfolio cash flows. Does every single property cash flow? We have a couple, that are kind of subsidized, right, by the other properties. But those are appreciation plays for us.
right.
Like, hey,
Yeah,
okay, I'm willing to hold on to this for the next 5 years and lose a little bit of cash. I'm not talking about like thousands of dollars, but I'm losing a little bit of cash. But that's okay because these other properties over here in our portfolio, they're cash flowing like
yeah,
crazy and we're doing great. Right. So I think as you evolve as an investor, you start to understand, can I do that? Do I want to do that? If I don't want to do that, let's get rid of that
That's
property and
right.
move on.
Yeah.
Right. So
I have seen it before where people are looking at buying the real estate investment as a way to replace their income. And if you do that too quickly, you're playing with fire right there.
yeah,
You can't just, bet everything on one property replacing your income. It's like you
yeah,
said, you got to build that portfolio to get to that point, and you got to be okay with any given property cash flow breaking even or going cash flow negative.
right.
Two more questions. What happens if rents do not rise as fast as expected? Am I going to be okay?
Hmm.
What happens if the property does not appreciate in the next 3 years or 5 years? Will I be okay? There
Hmm.
are a lot of people that failed to ask themselves that question 3 years ago, and now they're hurting.
I know you said two questions, but I want to do one more.
Go
And
ahead.
because I think this is a very good exercise for people to do, especially as your portfolio grows, is periodically you should be doing an audit of your portfolio, taking a look at all of your properties that you have in there, all of your assets, and then asking yourself, is this helping my goals? Right? Is it getting me closer to where I want to be, or does it just look good on paper?
Yeah,
Right?
that's good.
So yeah, doing that, I think doing that at least once a year, right? We love January 1st so much is not only your personal goals, but looking at your portfolio goals. What are those for the year? What was the last year look like? Do you have some losers in there that you need to start figuring out some things to do?
I love it. I love it. Well, I'm
Awesome.
excited about this series. Albert, welcome back. Welcome home. I'm glad you
Thanks,
had a
brother.
great trip. Thank you, everybody, for joining us on the call today. Don't forget, subscribe and like on YouTube, Spotify, Apple. Join us on Facebook. Don't forget to comment and all that stuff. But appreciate everyone being a supporter of the show. Don't forget to comment and let us know, what are you wanting to learn? Do you have a topic that you want us to hit? Are you curious about something? If you have questions, we do this call live, so you're always welcome to jump in and to interact. So, but that's it for today. We'll be back on next week. Appreciate you, brother. Everyone, have a wonderful day.